November of 1910, a group of the most powerful men in America boarded a private railcar in Hoboken, New Jersey, using fake names. The official story was a duck hunting trip. What they actually did on that island over the next 9 days would quietly reshape every dollar you have ever earned. Those 9 days at Jekyll Island quietly reshaped every dollar you have ever earned, every loan you have ever taken, every recession you have ever survived. The institution they designed that week was specifically built to benefit the people in that railcar. That tension between public mandate and private power has never fully gone away. It is the engine underneath everything the Federal Reserve has ever done. The tension between serving the public and serving the powerful was baked in from day one. The Federal Reserve turns 111 years old, and most Americans cannot tell you what it actually does. They know it exists, they know it raises and lowers interest rates. To understand why the Federal Reserve exists, you have to understand what America's banking system looked like before it, which is to say you have to understand chaos. America in the 19th century had no central bank. It had thousands of individual banks, each printing their own currency, each operating with their own reserves. The federal government had tried twice to create a central bank. First with Alexander Hamilton's Bank of the United States, chartered in 1791. Then again with the Second Bank of the United States, chartered in 1816. Both times the bank was eventually killed. Andrew Jackson personally destroyed the second one in 1836 because he believed it was a corrupt institution serving wealthy Eastern elites at the expense of ordinary Americans. Without a central bank, the American financial system experienced what economists politely call panics roughly every 15 to 20 years. The Panic of 1837, then 1857, then 1873, each one a full-scale economic collapse that wiped out businesses and threw millions out of work, all because there was no lender of last resort to stop the chain reaction before it started. The panic that finally forced the issue arrived in 1907, and it started with a failed attempt to corner the copper market, a single scheme that would unravel the entire banking system within weeks. Augustus Heinze, who built his fortune in Montana copper, moved to New York, got into banking, and tried to squeeze short sellers in the copper market, a scheme that collapsed within days. When the scheme collapsed, it revealed that Heinze's bank, the Knickerbocker Trust Company, was tangled in the whole mess, and word spread like wildfire through New York's financial district. Within 3 days, the Knickerbocker Trust Company failed, and because every bank in New York was connected to every other, the panic spread from bank to bank like a virus through a crowded city. Here is what made this moment so extraordinary. The United States Treasury had no tools to stop it. The government was essentially powerless as the financial system collapsed around it. The man who stopped the panic of 1907 was not the president or the Treasury Secretary. It was a 70-year-old private banker named J. Tampont Morgan, who summoned the presidents of every major New York bank to his personal library on Madison Avenue. Morgan refused to let them leave until they agreed to pool their reserves and backstop the failing institutions. One man, with no democratic accountability, personally decided which banks were worth saving and which were not. Theodore Roosevelt watched from the White House and was alarmed. Congress was alarmed. Even the bankers were alarmed because Morgan was 70 years old and nobody knew what would happen next time. The obvious answer was that America needed an institution that could do what Morgan had done, but with public authority and some degree of democratic accountability, not in a private library at 2 in the morning. In November of 1910, Senator Nelson Aldrich of Rhode Island, who chaired the Senate Finance Committee and was also the father-in-law of John the 500th, Rockefeller Jr. organized a secret meeting at Jekyll Island, a private retreat off the coast of Georgia. The men who attended used only their first names to avoid being identified, among them Frank Vanderlip of National City Bank, Henry Davison of J.P. Morgan, Paul Warburg of Kuhn Loeb, and Benjamin Strong, also of the Morgan Orbit. The men who gathered there represented the biggest names in American finance, the Morgan interests, the Rockefeller Empire, the Vanderbilt fortune, each sending a trusted lieutenant to shape the thing being built. Between them, the men in that room controlled roughly a quarter of the entire world's wealth. Not a quarter of American wealth, a quarter of everything on earth. Over 9 days, they drafted the blueprint for a central bank. Not a government agency, not a private club, but something in between that could serve both masters at once. The real goal was not protecting ordinary Americans from panics, though that was the public argument. The real goal was creating a lender of last resort that the big banks themselves could access when they needed it, without depending on any single private banker like Morgan. Paul Warburg, one of the architects, later admitted in his own writings that the key was to make the institution look like a government agency, while preserving the influence of the major banks. He said it plainly. The design they settled on was a compromise. 12 regional Federal Reserve banks, each owned by the member commercial banks in its district, with a Federal Reserve Board in Washington appointed by the president. Partly public, partly private, fully clever, the Federal Reserve Board appointed by the president was supposed to provide democratic accountability. The regional banks owned by their member banks were supposed to provide private sector expertise. Neither side was happy. That was the point. Woodrow Wilson signed the Federal Reserve Act into law on December 23, 1913. The bill had been debated for years, rewritten multiple times, and passed through Congress largely on the promise that it would prevent future panics. Wilson himself had serious reservations about banking concentration. He believed the big banks had too much power. He signed the bill anyway because the alternative, more unmediated panics, seemed worse. Wilson later wrote one of the most haunting confessions any American president has ever made about the financial system. He said he had unwittingly ruined the country by delivering the nation's credit into the hands of a few men. The Fed officially opened for business in November of 1914, right as World War I erupted across Europe. Its first major test was not a financial panic. It was war finance. The government needed to borrow enormous sums to fund the war, and the Fed helped by keeping interest rates low and buying government bonds. A precedent was set. In crisis, the Fed serves the Treasury's needs first. When World War I broke out in Europe, the brand new Federal Reserve faced its first major test. It was not a financial panic. It was war finance. The Fed kept interest rates low and bought government bonds, subordinating its monetary goals to the government's need to borrow enormous sums. The 1920s arrived, and the Fed, still figuring out its purpose, kept credit loose for most of the decade. Money was cheap, stocks soared, real estate prices climbed. The Roaring Twenties were a story of what happens when credit is too cheap for too long. Americans borrowed heavily to buy stocks on margin, putting down as little as 10% cash. The rest was loaned by banks, creating a pyramid of debt that depended entirely on prices continuing to rise. Nobody asked if the fundamentals justified the prices. Before I tell you what happened next, I want to make you a promise. In a few minutes, I'm going to show you the single worst decision the Federal Reserve has ever made. A decision so catastrophically wrong that it turned a recession into the greatest economic disaster in modern history. And the men who made it thought they were doing the right thing. In August of 1929, the stock market began to crack. After years of easy credit and speculative frenzy, the first tremors hit, prices wobbled, then fell sharply. The party was not over yet, but the hangover was beginning. By October 24, 1929, Black Thursday, panic selling had set in. Crowds gathered outside the New York Stock Exchange as prices plummeted. Banks tried to stabilize the market by buying shares, but the selling was too relentless. On October 29th, Black Tuesday, the market lost roughly a third of its value in just a few weeks. The Dow Jones Industrial Average fell by 12% in a single day. The crash was complete. The Roaring Twenties were over. Banks that had lent money to investors to buy stocks now found those loans worthless. Depositors, terrified, started withdrawing their savings. More banks failed. The credit system seized up. Businesses could not borrow to make payroll. Workers were laid off. The spiral accelerated. The textbook answer to a banking panic, the one Walter Bacot had laid out for the Bank of England in the 1870s, was clear. A central bank should lend freely to solvent institutions at a penalty rate, flooding the system with liquidity until the panic exhausts itself. The Federal Reserve did the opposite. Between 1929 and 1933, it allowed the money supply to shrink by roughly a third. Instead of flooding the system with liquidity, it stood by as the economy suffocated. It was the single worst policy decision in the institution's history. In 1931, in the middle of the worst banking crisis in American history, the Fed raised interest rates. It was worried about the gold standard and currency speculation. It chose to defend the dollar's link to gold rather than save the banking system. The result was catastrophic. Thousands of banks failed. Unemployment reached 25%. Gross domestic product fell by nearly 30%. The Great Depression was not just caused by the stock market crash. It was caused by the Fed failing to do the one thing it existed to do. Gross domestic product fell by nearly 30%. The economy did not just shrink. It collapsed into something that had no modern precedent. Milton Friedman and Anna Schwartz published their landmark study in 1963. They called it the Great Contraction and laid the blame squarely on the Federal Reserve's inaction. Ben Bernanke, later Fed chairman, gave a famous speech at Friedman's 90th birthday. He said, on behalf of the Federal Reserve, that the research was right and that the Fed would not do it again. In 1933, Franklin Roosevelt took the United States off the domestic gold standard. It was a move that would have seemed unthinkable a decade earlier. Americans were legally required to hand in their gold coins and certificates to the Federal Reserve in exchange for paper dollars. The government took their gold and gave them printed money. The gold price was reset from $20.67 per ounce to $35 per ounce, a massive effective devaluation of the dollar. The relationship between the dollar, gold, and the Fed was not fixed. It could be rewritten under political pressure. That lesson mattered enormously after World War II. In July of 1944, delegates from 44 nations gathered at the Mount Washington Hotel in Bretton Woods, New Hampshire. They were there to design the post-war monetary system. The US dollar became the world's reserve currency. Every other currency was pegged to the dollar, and the dollar itself was convertible to gold at $35 per ounce. The Federal Reserve was now not just America's central bank, it was the backbone of the entire global financial system. Because the dollar was tied to gold, the Fed could not simply print money freely. If it created too many dollars, foreign governments could demand gold in exchange, and American reserves would drain away. In 1951, the Treasury-Fed Accord gave the Federal Reserve operational independence from the Treasury. The Fed would not be required to finance government deficits at artificially low rates. Lyndon Johnson was financing the Great Society and the Vietnam War at the same time, and he did not want to raise taxes. He wanted the Fed to keep money cheap. William McKesney Martin, the longest-serving Fed chairman, is famous for one line: "The Fed's job is to take away the punch bowl just as the party gets going." Johnson reportedly grabbed Martin by the lapels at his Texas ranch and demanded he keep rates low. Martin complied more than he should have. Inflation began creeping upward through the late 1960s, a slow leak that would soon become a flood. By 1971, Bretton Woods was under severe strain. The United States had been running large trade deficits, spending heavily on both war and domestic programs. Foreign governments, particularly France under Charles de Gaulle, had been converting their dollar holdings into gold at an accelerating rate. American gold reserves were draining. The math was becoming impossible. The U.S. could not honor its commitment to exchange dollars for gold at $35 per ounce indefinitely. On August 15, 1971, a Sunday evening, Nixon appeared on television and announced that the United States was suspending the convertibility of the dollar into gold. Just like that, the link between the dollar and anything physical was severed. The dollar became a fiat currency, valuable because the government said it was. Every major currency in the world soon followed, because every major currency had been pegged to the dollar through Bretton Woods. Money was now backed only by government decree, by the faith and credit of the United States. For the first time in history, every major currency was pure fiat. Arthur Burns became Fed chairman in 1970. He was Nixon's former economics professor and mentor, and Nixon leaned on him hard to keep rates low. White House recordings later made public captured Nixon pressuring Burns repeatedly, warning him that he would be publicly blamed if the economy slowed. Burns complied, he kept money loose. Nixon won in a landslide. And then the inflation that had been building for years, turbocharged by loose monetary policy, exploded. Then the oil shock of 1973, when OPEC cut production and quadrupled oil prices, pushed inflation into something nobody in Washington had a good answer for. Economists coined a new word for it, stagflation. High inflation and high unemployment simultaneously, which the prevailing models said was impossible. Inflation reached 13% by 1979. The dollar lost more than half its purchasing power in a single decade. Jimmy Carter appointed Paul Volcker as Federal Reserve Chairman in August of 1979. Volcker was 6 feet 7 inches tall, perpetually chewing cheap cigars, blunt in a way Washington officials almost never are. He believed, with something approaching religious conviction, that inflation was the enemy of ordinary working people, a hidden tax punishing anyone who saved money or earned a wage. In October of 1979, in a Saturday press conference designed to minimize immediate market panic, Volcker announced a fundamental shift. The Fed would target the money supply, not interest rates. The federal funds rate rose from around 11% in 1979 to a peak of 20% in June of 1981. 20%. If you were a small business owner trying to borrow money to buy equipment in 1981, you were paying interest rates incomprehensible today. Home buyers faced mortgage rates of 18 or 19%. The housing market essentially stopped. The auto industry went into free fall, unemployment climbed past 10%. Volcker was burned in effigy in some places. Farmers drove their tractors to Washington in protest. Home builders mailed him 2x4s. Home builders mailed him 2x4s with angry notes carved into the wood. Farmers drove tractors to Washington and blocked Constitution Avenue. Congress received more letters demanding Volcker's resignation than any Fed chairman in history. Volcker did not move. He sat in his office, smoked his cheap cigar, and kept the federal funds rate at 20%. Carter lost the 1980 election largely because of the economic misery Volcker's policy had deepened. The Fed chairman did not blink. Reagan came into office in January 1981. The economy was contracting. Republicans lost seats in the 1982 midterms. Reagan, to his lasting credit on this issue, left Volcker in place. He understood that killing inflation mattered more than short-term politics. By 1983, inflation had fallen from 13% to around 3%. Not gradually, not accidentally. Volcker had crushed it. The same tight money that caused so much pain had also cleared out the dead wood and forced businesses to become efficient again. The economy recovered with extraordinary speed. The same medicine that nearly killed the patient also cured the disease. By 1984, growth was roaring back. Volcker had proven that a central bank with genuine independence and the will to act could actually control inflation. But here is the open loop. Volcker proved the Fed could use pain to kill inflation. What happens when the Fed uses the opposite tool for almost 2 decades? Unlimited cheap money. What does that build, and what does it eventually become? Alan Greenspan replaced Volcker as Fed chairman in August of 1987. He was a disciple of Ayn Rand, a devotee of free markets, and a man who believed that financial innovation was almost always a force for good. The maestro was about to take the stage. October 19th, 1987. The Dow Jones Industrial Average fell 22% in a single day, more than it had lost in the entire first year of the Great Depression. One day, the financial system teetered on the edge of complete collapse. Greenspan, 2 months into the job, responded within hours. He flooded the banking system with liquidity. He cut interest rates. The Fed announced it would lend freely to any solvent institution that needed it. The crisis passed almost as quickly as it had arrived. The market recovered. The economy barely noticed the crisis. Greenspan was hailed as a genius, but a pattern had been set. Every time markets got into serious trouble, the Fed would cut rates and inject liquidity. The implicit lesson, the Fed would always be there. Markets coined a term for it, the Greenspan put, a term borrowed from options trading. It meant Greenspan had essentially written an insurance policy guaranteeing that losses beyond a certain point would not be allowed to persist. The Fed would always rescue you. The Greenspan era lasted 18 years. It covered the savings and loan crisis, the Gulf War, the Mexican peso crisis, the Asian financial crisis, the Russian default, the collapse of long-term capital management, the dot-com bubble and its implosion, and 9/11. Every crisis got a rate cut. Time magazine put Greenspan on the cover alongside Treasury Secretary Bob Rubin and Deputy Treasury Secretary Larry Summers under a headline that captured the era's confidence: the Committee to Save the World. Greenspan's congressional testimony became a spectacle. He spoke in a deliberately impenetrable language that journalists and analysts parsed like ancient prophecy. He once said, and this is a real quote, that if you thought you understood him, he had not made himself clear. Through the 1990s and into the 2000s, financial innovation was accelerating faster than regulation could follow. Banks created instruments of extraordinary complexity that regulators barely understood. Banks were bundling mortgages into securities, slicing those securities into tranches, and selling those tranches to investors worldwide. The rating agencies slapped AAA ratings on instruments that were, underneath all the complexity, bets on whether American housing prices would keep rising. Greenspan himself acknowledged the growth of subprime lending in congressional testimony, but expressed confidence that financial innovation had distributed risk so widely through the system that no single failure could cause systemic damage. Greenspan retired in February of 2006, replaced by Ben Bernanke, the Princeton economics professor who had made his academic name studying the Great Depression. The timing was, to put it gently, not ideal. Housing prices peaked in 2006. By 2007, subprime mortgage defaults were rising. Bear Stearns, one of the largest investment banks on Wall Street, was forced to shut down 2 of its hedge funds that had been heavily invested in mortgage-backed securities. In March of 2008, Bear Stearns, a firm with nearly 100 years of history and nearly $400 billion in assets on its books, collapsed over a single weekend. The Federal Reserve arranged an emergency rescue, effectively brokering a sale to J.P. Morgan Chase at $2 per share. $2 per share. Bear Stearns had traded at $172 per share just 14 months earlier. $2 per share. On September 15, 2008, Lehman Brothers, the 4th largest investment bank in the United States, filed for bankruptcy. It was the largest bankruptcy filing in American history. Unlike Bear Stearns, Lehman did not get a rescue. Treasury Secretary Hank Paulson and Fed Chairman Bernanke made the decision not to arrange a bailout. Whether they could not find a buyer, believed the market could absorb the shock, or needed to make an example after Bear Stearns, the result was the same. The debate continues today. Global lending freezes. Banks stop lending to each other because nobody knows which balance sheet is hiding the toxic mortgages. The system seizes up in a way that Bernanke had spent his entire academic career studying. Money market funds, which Americans treat as safe as cash, break the buck for the first time. Their net asset value falls below $1 per share. The safe place was never safe. AIG, the insurance giant that wrote reckless credit default swaps, requires an emergency bailout of $182 billion. $182 billion for a single insurance company. Bernanke cuts the federal funds rate to essentially zero. He creates emergency lending facilities of dizzying variety. The Fed starts buying commercial paper directly, acting as the money market for the entire American economy. November of 2008. The Fed announces something never done before in American history: quantitative easing. It creates new money electronically to buy financial assets, primarily government bonds and mortgage-backed securities. The Fed creates over $1 trillion out of nothing, legally by typing numbers into a computer. It buys $1.25 trillion in mortgage-backed securities and $300 billion in treasury securities. The intervention prevents what might have been a second Great Depression. But unemployment still peaks at 10% in October of 2009 and remains stubbornly high for years afterward. Inequality widens as asset owners recover faster than wage earners. The gap between people who own stocks and real estate and those who live primarily on wages grows wider than at almost any point in recent American history. Bernanke wins the Nobel Prize in Economics in 2022 for his research on bank failures and financial crises. The man who tested his theories in real time on the biggest crisis in 80 years gets the prize. Janet Yellen succeeds Bernanke in February of 2014, becoming the first woman to chair the Federal Reserve in its 100-year history. Yellen inherits a balance sheet swollen to roughly $4.5 trillion from multiple rounds of quantitative easing. Her challenge is the reverse of the crisis: how to remove the extraordinary support without destabilizing the recovery. Jerome Powell is appointed Fed chairman by Donald Trump in February of 2018. Trump later attacks him publicly, pressuring the Fed to keep rates low, reviving the old question: is the Fed truly independent? Powell, facing Trump's public attacks, raised rates in 2018 anyway. He didn't yield. The Fed's independence held for now. Then March 2020, the World Health Organization declared a pandemic. Markets crashed 34% in 33 days. The fastest collapse from an all-time high in history. Powell cut rates to zero in 2 emergency meetings. He announced unlimited quantitative easing. The Fed would buy as many bonds as needed for as long as needed. For the first time ever, the Fed bought corporate junk bonds. Bonds from companies Wall Street considered likely to default. The Fed became the buyer of last resort for everything. The Fed's balance sheet swelled from around $4 trillion before the pandemic to nearly $9 trillion by early 2022. $9 trillion created electronically. Then inflation came back. It hit 7% in 2021, then kept climbing, peaking above 9% in June 2022. The fastest inflation in 40 years. The Fed responded with the fastest rate hiking cycle in 40 years, raising the federal funds rate from 0 to 5.5% by July 2023. By late 2023, inflation had fallen toward 3%. The economy had not entered a recession. In September 2024, the Fed began cutting rates again, signaling the crisis was contained. But the founding contradiction endures. The Fed is a public institution with a democratic mandate, yet its decisions are shaped by the financial actors it is supposed to regulate. That's the final thread. Whoever controls the price of money shapes who wins. And that question, who does this institution serve, has never been fully answered. Subscribe for the next thread.